The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and welcome to the Vulcan and Gutton Plan Payroll Protection Program Update and Maximizing Loan Forgiveness. This is our fourth webinar on this series. If you've tuned into some of the previous webinars, you will recognize some of our presenters today. My name is Bill McDevitt. I'll be moderating today's presentation. Len Nitti will be one of the speakers, along with Dan Fiorentino and Carolus Matulis. A little bit of housekeeping. Number one, if you would like a copy of the handout, it should be visible on your right-hand side. There should be something you can click on to just simply download today's handout. A caution with the handout is that it's accurate as of today. This situation is fluid, and we continue to get guidance as things move along. So the content of the webinar and the content that's in the presentation is current as of today. If you would like to ask a question, also on the right-hand side in the GoToWebinar dashboard on your screen, there is a panel where you can drop questions in. We will try to get to as many questions as possible at the end, but we have an awful lot of material to cover, so it might be difficult to do so. But in any event, we'll do our best. And last, in the form of housekeeping, the webinar is going to be recorded and will be uploaded to our website so that anyone who would like to either re-listen to it or listen to a specific part or have someone who didn't participate today listen to it can do so by going to our webpage. So the agenda today is basically, and it's a healthy agenda, basically we're going to recap the loan basics and the impact of the PPP Flexibility Act. We're going to talk about a few safe harbors, and then we're going to talk about, importantly, applying for forgiveness and completing the application form in some detail. We're going to show you the tool that we've built to assist in analyzing the data in preparing your forgiveness application. And last but not least, we're going to talk about techniques to maximize loan forgiveness and point out some of our recommendations. So before we get into the detail of this, we're going to talk about the current political situation. As you may or may not know, there's a presidential election coming up in less than 2 months. This has caused a little bit of gridlock in Washington, maybe a little more than there normally is. The House went back into session as of yesterday, and there's some hope that some agreement will be reached for a further stimulus package. And when we talk about stimulus, we're not just talking about payroll protection program loans. We're also talking about the possibility of individual stimulus checks to individual people, federal supplemental unemployment insurance, as well as a second bite at the apple for certain people who've really been harmed for a payroll protection program loan. Basically, the House-controlled Democrats are looking for a much bigger bill than the Senate-controlled by the GOP. They're looking for a smaller, more narrowly focused bill. There's a belief that there could be a compromise on a dollar amount, but the real sticky point is what the money will be spent on, and both sides have different points of view about how that money should be spent. I've given up trying to predict what will happen in Washington. I hope something positive does happen before they break for the election, but I'm not certain that'll be the case. So in any event, with that little political update aside, we're going to move on to the program, and I believe Len Nitti is going to start us off.
Thank you, Bill. So first topic of the day is going to be the Paycheck Protection Program Flexibility Act and how that combines with loan forgiveness. And that's why everybody's here, to understand how their loan will be forgiven, what you need to do. This law was signed into effect on June 5th, 2020, and that will become a somewhat important date. It makes significant changes to the terms of the original PPP legislation. One of them is it extends the covered period from 8 to 24 weeks. That ends up being very significant in business's ability to pay enough expenses to have the full loan forgiven. We'll talk more about that in a bit. Another big one was changing the amount that you could use for non-payroll costs. Originally, the SBA determined that it should be 75% payroll, 25% non-payroll. The Flexibility Act increased that from 25% to 40% for non-payroll costs, making it much easier to utilize those funds for non-payroll costs. That was a big concern when we were under the 8-week covered period. It extends the safe harbor, which Dan will talk about, from June 30th all the way out to December 31st of this year. The terms of the loans also changed for loans that are obtained after the act was passed. Rather than having a 2-year term, it extends to 5 years. And one thing we've seen for a few banks is some banks were actually just giving a blanket 5 years, where they're actually sending new loan documents to borrowers to change the payback period from 2 to 5 years. So that would only apply if you had any amounts that were not forgiven. Gives you 5 years to pay it back now for newer loans. And some borrowers, were well within their 8-week covered period, if not almost completely done with their covered period when this law was passed. So this threw some chaos into the mix, where businesses were frantically trying to figure out how to spend enough money to have their loans forgiven, and challenges where you weren't able to get all your employees back and meeting the 75% test. So this effectively allowed everyone to take a deep breath and have more time to get all this done, and actually have the intent of the law, which was to get this money to businesses, and as long as you do the right thing with it, the government was going to forgive this for you. So you can flip to the next slide, Bill. So the basics. Loan forgiveness is available for proceeds spent on qualifying costs paid or incurred during the covered period, all the alternative covered period, and we'll talk about all of these in a little more detail. We already said non-payroll costs are now limited to 40% of the forgiveness amount. You must apply for forgiveness with the lender within 10 months after the covered period ends. The lender has 60 days to issue a decision on the loan forgiveness, and then turns it over to the SBA, who has 90 days to remit the forgiveness amount to the lender, at which point the loan will either be fully forgiven or partially forgiven. And if it's not fully forgiven, it becomes a loan which is due in either 2 or 5 years, pending when you originally got your loan. The interest rate continues to be fixed at 1% rate, and payments are deferred until the date the SBA informs the lender of the forgiveness amount. So payments wouldn't be due for quite a while. No prepayment penalties or fees if you have loan that needs to be paid back and you do it early. One other thing just to note is, as we're talking about going through and doing the applications, I'm sure Dan will talk about this in more detail, but this has been a challenge for a lot of businesses, is that we still don't have perfect guidance and information from the SBA. And oftentimes we've seen where you get conflicting guidance. They flip-flop. They come out, they give you guidance in terms of what you are able to do, and then a couple of weeks later they'll get some pushback and they'll actually change the rules. This happened a lot with obtaining the loans, and we've seen it happen here already. So keep an eye out. There may be additional guidance that comes from the SBA, and there are certainly some unanswered questions. So what we tell you today is always subject to change pending future guidance from the SBA, but we will get that info out to you quickly. So what is the covered period? The covered period now is a 24-week period, but borrowers who had their loans prior to June 5th can elect 8 weeks if they like to and want to accelerate the forgiveness process. Covered period begins on the date that the PPP loan proceeds are received. There's an alternative payroll covered period for businesses if they would like to elect it. It only applies to businesses that utilize weekly or biweekly payrolls, and effectively you're allowed to begin your payroll covered period on the date that you begin your next regularly scheduled payroll. This way, your payroll cycle is in sync for the next 24 weeks for purposes of determining whether or not you spent enough payroll costs. So what costs qualify for loan forgiveness? Payroll costs, which must be at least 60% now, down from 75%. Any payments of interest on any covered mortgage obligations, excluding principal payments and prepayments, penalties. Mortgage must have been in place and incurred prior to February 15th, 2020. Any payment of a covered rent obligation, leases must have been enforced prior to February 15th, 2020. We had a big open question as to whether or not related party rent would be respected as a forgivable cost. We'll touch base with that later, but we did finally get guidance on that. Any covered utility payment for which services began before February 15th, 2020. We'll go through that in some more detail as well in a few minutes. So forgivable payroll costs are paid or incurred during the covered period. Certainly it's easy to understand what paid is, but incurred, so if you had a payroll at the end of the cycle that partially it falls within the covered period and partially goes beyond it, and the payroll is paid after the covered period is completed, you'll be able to do a proration and accrue those payroll costs which were incurred during the covered period but paid afterwards to be good payroll costs for purposes of forgiveness. Payments to furloughed employees qualify for payroll costs. Bonuses and hazard pay also qualify. Payroll costs definition, could be salary, wages, commission, payment of cash tips, vacation pay, family medical sick leave, allowances for dismissal or separation, severance pay types of items, payments required for group health care benefits, payments of retirement benefits, and payment of any state or local taxes assessed on the compensation of employees. Here in New Jersey, that'd be unemployment and disability most commonly. So payroll costs, what don't they include? There's a $100,000 cap based on a prorated annual salary during the covered period. We originally had this magic number of $15,385 per employee when we were at an 8-week covered period. And if you elect an 8-week covered period, it stays at the $15,385. But since we've been expanded for 24 weeks, the government did confirm that that number is now grown to allow for payroll costs of up to $46,154 to be covered for 24 weeks. One exclusion or one difference from that, which we'll talk about in a few minutes, is for owners. Owners are going to have a lesser cap than the $46,154. Also doesn't include any compensation of an employee's principal's place of residence is outside of the United States. Qualified sick leave wages for which a credit is allowed under the Family First Coronis Act. They're not going to allow you to double dip. So if you've taken advantage of the payroll tax credit, you're not also going to be able to have those payroll costs forgiven. And qualified family leave wages are not included either. So limitations on owner compensation amounts, and this is one where they flipped on us. Where initially they gave us guidance that put all owners, whether it was owner of a corporation or a sole proprietor or an owner of a partnership, they kind of put them all in the same bucket. And using the 8-week period, they'd be capped at $15,385 of compensation. Using the 24-week, that grows to $20,833. And essentially what it is that is the portion of their earnings that they would have received PPP loan proceeds for. So the government doesn't want you to be able to reimburse yourself with more than they had given you relating to your compensation for purposes of calculating the loan. And the cap is per individual and total across all businesses. So if you own 4 or 5 different businesses that got loans, you're going to be capped at $28,833 for all businesses. So here's what we ended up with. I had said that initially when they gave us guidance on forgiveness, they put all owners in the same category. Then they later gave us guidance changing the rules and treating different types of owners differently. So for a C Corp with 5% or more ownership stake, 2.5 of 12 months of cash compensation. That's the 20,000 number. State and local is eligible to be reimbursed. It's not part of the compensation. Health insurance is eligible. It's not part of the compensation. Retirement contributions are eligible, and it's not part of the compensation cap, but it's limited to only 2.5 months of the 12 of the 2019 amount. So they're not going to allow you to increase and make larger retirement contributions just to have your amounts forgiven, nor prepay a full year for an owner to try to take advantage of this. Then we get into the S Corps, and it's slightly different rules for a 5% or more owner. And just of note, if you're less than a 5% C or S Corp owner, you're treated just like any other employee. So these caps don't count for you. State and local taxes, the unemployment and disability, it's not part of the cap. You can't have these reimbursed or forgiven. Health insurance for S Corp owners are not eligible, including any family members who are employees. So that's a big difference from a C corporation. Is health insurance is part of the $20,000 cap. And for retirement contributions, it is eligible. You're not part of the cap, the compensation cap, but it is limited, like C Corps, to 2.5 out of 12 months of the 2019 amount. Sole proprietors or general partners in a partnership who were able to get reimbursements for their lost compensation or lost earnings, very different story compared to corporate owners. You're not entitled to any deductions for state and local taxes, health insurance, or retirement contributions. So advantage, again, we go back to now this being an advantage for corporate owners compared to others. You can flip forward, Bill. So forgivable non-payroll costs paid or incurred during the covered period. Same rule as with payroll costs. If you incur the expense during the covered period, but as long as you pay it by your next scheduled payment date, you're okay to include it as forgivable costs. Advance payments of interest on mortgage loans do not qualify, but other advance payments do appear to qualify, or at least they haven't told us that they don't qualify at this point. So for mortgage interest on mortgages on real property, interest payments on debt for personal property such as auto loans, equipment loans, things of that nature. Principal payments do not qualify, and we said earlier the mortgage had to be incurred prior to February 15th, 2020. One big item for mortgage costs is that if you have related party mortgage debt, you're not going to be able to have the related party mortgage interest forgiven that you're paying. The intention that the government said was to pay third-party costs, not related party costs for purposes of mortgage interest, at least. For non-payroll costs for lease payments, payments on leases of real property, payments on personal leases, auto leases, equipment leases qualify. And again, you have that same February 15th date for the lease agreement having to be in place. So additional guidance on leases and related parties. What they've told us is any amounts attributable to the business operation of a tenant or subtenant of the PPP borrower does not qualify for forgiveness. So if you're being reimbursed by a tenant or a subtenant of your space, you can't include that even though you're making the full payment to the landlord. Also, in the context of home-based businesses, they determine that household expenses are not eligible for forgiveness. So even though you're using a portion of your home for your business, you're not entitled to a portion of the electricity, mortgage interest, and any other items that would be forgivable. They're just not they're not forgivable for purposes of household expenses. Also, the forgivable portion for related party rentals, they gave us guidance that you can be forgiven for amounts, but they're not going to allow you to be forgiven for the gross rental amount. You're only going to be forgiven to the extent that the related party is making mortgage interest payments to a third party. So if there's no debt on that building that's being rented by a PPP borrower business, they're not going to be entitled to have forgiveness for any related party rent. It's only for mortgage interest being paid to a third party. So you have to do a look through from the landlord, from the tenant entity to the landlord entity, and figure out what the mortgage interest was paid during the covered period so that that could be forgiven. So here are the other non-payroll costs for utilities: electricity, gas, water, telephone, internet, and the last one is transportation, which was very vague and undefined in the law and initially by the SBA. And it was very questionable what qualifies. Do UPS fees or FedEx charges qualify? Do gas paid on the company cars or company trucks qualify? And the SBA came out in the frequently asked questions and gave us a very narrow answer of what qualifies for transportation costs. And it's defined to be a service for the distribution of transportation, refers to transportation utility fees assessed by state and local governments. So it's only fees assessed by state and local governments that qualify here. So that really makes this a much more narrow interpretation and probably disqualifies transportation costs for many traditional trades or businesses. And again, these services had to be in by that February 15th date. And with that, I'm going to turn it over to Dan to talk about the full-time equivalent limitation and move us forward.
Okay, thanks, Len. So just the kind of background with this, there's two main ways that you could potentially get your loan forgiveness amount limited. That's based on a full-time equivalency calculation, which is your headcount roughly, or if there's significant reductions in your salary or your hourly rates. So I'm going to give you a quick background on how those tests are performed, and then we'll give you some safe harbors and ways you can get around them. The first one that you can see here is the full-time equivalency limitation. Basically, what they want to see is that you didn't drop your headcount very far from what it used to be. So you have to compare your FTEs during your covered period, and you have the option comparing that to two different periods. The one period is from February 15, 2019 to June 30th, or you can choose the first 2 months of 2020. Now, you want this ratio to come as closest to a 1 as possible. So you're going to want to pick a comparative period that has a low number. So if you had 30 FTEs in 2019 and you now have 20 FTEs in 2020, you're going to opt to use the 2020 period because you want to use a low baseline to compare that to. Okay, thank you. So in order to calculate this, the FTEs are based on a 40-hour work week. And each employee, even if they're working over 40 hours, the max they can be is a 1. So if you have an employee that regularly works 50 hours, you don't get to count them as a 1.25. They're going to count for you as a 1. Now, you do have two different options for calculating this amount. You can actually just do the straight up calculation and round everyone to the nearest 1 decimal place. So for example, if you had an employee working 32 hours out of 40, they would be a 0.8. But they offer a simplified method where any employees working 40 and above count as a 1, and then anyone below that is a 0.5. So a 39-hour employee or a 1-hour employee are both a 0.5. And there's a pretty good planning opportunity here where you can take advantage of that in certain situations. For example, if you had a lot of employees that were working under 20 hours and you elected the simplified method, instead of being 10 hours out of 40 and a 0.25, they're now all going to automatically count as a 0.5. So in certain situations, you can definitely get a better statistic if you're using the simplified method. Just keep in mind you have to use a simplified method for both your comparative period and for your covered period on there.
Hey, Dan, if you don't mind, there's a question that's come in from a number of different people regarding the FTE calculation. And the question is, does it have to be the same we're counting in periods or changes in person?
I think I heard you correctly. You said, does it have to be the same people or can you change personnel? Is that what you asked?
Right, if someone left and you replace them with another person.
I got you. Yeah, no, you can replace them with another person, And we're actually going to get into this a little bit when you have employees, that left and you had to get someone to replace them, but it does not have to be the same people. They want to see overall, did you have 40 employees during those first 2 months of 2020? And now it could be 40 new people, but you still had 40 people employed during your comparative period. Good question. Okay, so the first way they get you is based on the FTEs, and the second way they can get you is if there's any reductions in the salary levels or the wage levels. And this only applies to employees making $100,000 and less. In the government's perspective, anyone making over $100,000, you can actually reduce their salary as much as you want, and there's no penalty to that. That's from their perspective. So for all these employees making 100 and less, you're allowed to reduce their hourly rate or their salary by up to 25%. But when you exceed that 25%, then there is going to be a penalty placed on that, and that could potentially limit the amount that you're allowed to get forgiven on here. So those are the two tests that we have to get, but now let's talk a little bit about ways to get around these tests, because there's some safe harbors in place. So first we'll talk about the FTEs and the two different safe harbors that they have set up in place. Now this first one, the FTE reduction safe harbor 1, is going to be very specific to certain industries. This is basically saying that if you could not restore your FTE headcount to what it used to be because of government mandates during a certain period of time, then you're not going to get penalized for that. And they're very specific about when these mandates came out and who passed them. So if you couldn't restore your FTE counts to the level they were at on February 15th, because of guidance passed between March 1st and December 31st, and this guidance had to come from one of three groups, either the HHS, the CDC, or OSHA, and it had to relate obviously to the pandemic and the COVID-19, like social distancing and everything, then you can check off a box and basically your FTE is a 1. You don't have to do that calculation because they're saying you had to comply with these government mandates, so you met the safe harbor, you don't have to worry about that. So in restaurants, for example, a lot of them have limits in place of how many people you can put in capacity. That's an area that this safe harbor could save them on that. Okay. The other safe harbor that we have in place, this one's probably going to apply to a larger audience, is the FTE reduction safe harbor 2. And in order to meet that one, so this is where if you dropped your employee levels between February 15th and April 26th, but then you're able to bring them back later, then you could potentially meet the safe harbor. And it's very specific on here that you have to have reduced them between February 15th and April 26th. And I'm going to come back to that when we look at the forms because they have a very specific example on there. But according to the current guidance, if you actually were trying to be the nice person and kept all your employees on board and didn't cut any until May 1st when we realized this thing is going to last a lot longer than anyone expected, you actually can't qualify for this safe harbor. You have to have those reductions first happening between February 15th and April 26th, which doesn't necessarily make sense practically, but that's how the current guidance is reading. Now, you have to restore these FTE levels by the earlier of the date you submit the application or December 31st. As Len mentioned earlier, they changed the safe harbor date from June 30th to December 31st when they passed the Flexibility Act. So this might be another planning opportunity where you shouldn't rush to submit your application if you think that you might be in better shape by the end of the year. Given the 24-week period, I bet a lot of people's covered period is going to be ending, late September, mid-October. Don't necessarily rush to put that forgiveness application in if you think you're going to have a better chance to meet a safe harbor later on because you're going to have more employees on there by December 31st. Just one option to have for you. So those are the two safe harbors, and there's actually a third way that you can kind of help yourself out in terms of meeting these FTE requirements on here. And this one's called an FTE reduction exception. And this one's actually very specific. It relates to the employee level, whereas those other ones were for overall all employees. This one relates to each specific employee where you can do a calculation. And if your employee was a 0.6 and maybe you meet some of this criteria, then you almost get a credit in a sense for a 0.4 so that they now count as a full 1 and you're not getting penalized. So the specific criteria on here, if you had an employee that you let them go and then you offered to bring them back but they refused, or if you reduce somebody's hours and then you tried to bring them back and they refused that as well, you're going to get credit for that and you're not going to get penalized. Also, for any employees that were fired for cause, voluntarily resigned, or they asked to have a reduction in their hours, then you could potentially meet this FTE reduction exception as well. Now, one thing to note on here, though, is in all these cases, you only get this exception if you didn't fill that with somebody else. So if you had an employee working 20 hours out of 40, you offered to restore them back to 40, they said no, and you got another person to fill in for those other 20 hours, you can't also get the FTE exception for that original employee. The max they want you to get is a 1 on here. But it is a nice way to help out if you're struggling with the headcount because a lot of people might have been in that situation for a while, especially with unemployment. They might have been making more and they refused to come back to work, to be honest. So this could help businesses out in that specific situation. Now, when you do have employees that are refusing to come back, it's very important, and they specify this in the guidance, that you have to have records documenting the offer in writing and its rejection from the employee in writing. And according to the guidance, you also have to let the state unemployment insurance office know that they rejected the offer within 30 days. From a practical sense, That's going to be tough for them to figure out if you actually did that, I would think. And they're supposed to give us more guidance on that, but unfortunately it never came out as of right now. Maybe they will down the road, but just know that the guidance does have this requirement in there. So do your best to make sure you're following the rules with that. You know, they're really just trying to put the burden on the borrower to make sure that they're staying in line and that we're not getting any of these employees that essentially are trying to double dip in a sense. Okay, so that's the FTEs, and now the exception for the salary and hourly requirements. The first point, eventually they're pretty much just saying that you're not going to get double penalized in a sense. If the reduction in their hourly rate is directly correlated to their FTEs, then you're not going to get double dinged. The second one on here is going to be more prevalent. This is similar to the FTE safe harbor. There's a safe harbor set in place for any employees that had a reduction in their salary or their hourly rate, just like the other rule. So it's very specific dates on here. If you dropped their salary between February 15th and April 26th, and then you brought that back by a certain date, then you meet the safe harbor and there will not be any penalty for this individual employee. And that safe harbor date on here is the earlier of December 31st or the date the application is submitted. Again, another planning opportunity. We don't know what the future is going to hold, but if you do think that things might get a little bit better for your business by the time December 31st rolls around, then again, it might not make sense to submit your application right away on here. You know, there could be ways that you can help yourself out. So those are the two main ways that you could be getting your forgiveness amount reduced if you don't meet the requirements for FTE or the salary requirements. However, and when we get to this on the form, I want to show you guys the penalty for the FTEs. There might actually be almost a loophole in a sense of that, where you can get around it based on the way the SBA has laid out their form. And I'm actually, in a couple of slides, going to pull up a copy of the form, and I'll walk you through exactly what I mean by that. But just keep in mind that this FTE penalty might not be as bad as you might be thinking at this moment. So now that we know the rules, let's talk about how you actually go to apply for forgiveness. So you're going to submit the application to the lender. And as I said, we're going to go through a copy of the application. It's a 5-page PDF from the SBA, but that's not where we're expecting most lenders to require. We think they're all going to have their online portals, which a lot of them are already coming online right now. You go into that portal, and it's not just upload your SBA application. They're going to have their own version of it where you have to punch all the numbers in there. It's going to be pretty much the same, but the banks were expecting to all have an online portal on here where you can enter all this information. So there's certain documentation that you're going to need to have, and we'll touch base on that in a little bit. You're going to have to sign off on certain certifications, similar to what you had to do when you got your original P3 loan. And as we mentioned earlier in the presentation, then your lender has 60 days to submit a decision to the SBA, and then the SBA has 90 days after that to reach the final determination. And we may have mentioned this before, I'm not sure if we did or not, but for federal tax purposes, don't forget, the amount of debt forgiveness is excluded from gross income. Okay? So I want to highlight on here, the SBA did specifically mention that they're going to be reviewing in detail all loans in excess of $2 million. So for those that have a loan over that amount, when you're submitting your application, just do your best to make sure everything on there is as accurate as possible. We don't know what the details are going to be in terms of what the review will be, but just know that it's going to be under special scrutiny, so you really want to make sure that you're in good shape with that. You know, I think the thought process behind that is there might not necessarily be a large volume of loans over $2 million, but in terms of overall dollar amount, that's a very large chunk of the P3 program. So by the SBA just selecting this bracket to do a very detailed, thorough review, you know, they think they're going to get a lot of coverage on that, potentially pick up anyone that maybe should not have gotten their P3 loan forgiven in the first place. Now, they're kind of already anticipating some people not being happy with the review, so they've already set up a process that you can submit an appeal to that through the SBA Office of Hearings and Appeals. I'm not going to get too in detail with that right now. Hopefully that's not going to need to be an issue for anybody, but just know that that's in place should you be stuck in that situation. You know, and if that happens, obviously work with us. We can help you out and we'll go through that step by step, but hopefully no one has to deal with that. So let's take a quick look at the actual application. As I mentioned before, it's a 5-page document that the SBA released back in June. It's possible they'll release a revised version at some point, but as of right now, this is what we're still going off of. I'm going to show you screen by screen what the pages are made up of, but just remember, you only actually need to submit pages 1, 2, and 3. Page 4 you hold for your records, and page 5 is an optional demographic page on there. And again, we don't expect that you're actually going to have to go through and fill out each one of these PDFs. The bank is going to have their own electronic format of this, but all the information is basically going to be the same. So taking a look at page 1, the top half of this is really just the company information, and the bottom half is really what's going to be important. So if we go to the next slide, we're going to drill into that top half briefly on here. Can you go to the next slide, Bill, please? There you go. Thank you. So on here, this is just general information about the company. You can see it's pretty straightforward. The name, the EIN, the loan number, the amount, that kind of stuff. If you have your original SBA loan documents and you have your application when you got your original P3 loan, this should be really easy to fill out. There's nothing too complicated on that. The bottom half of this page, when we look at that, that's really what's the most important part, maybe one of the most important slides in this presentation. If you want to scroll ahead to that one, Bill, I can show you. This part actually does the calculation for the forgiveness amount. And I put some numbers in here because I think it's really important that you understand how the SBA laid out this form. And I mentioned before that the FTE limitations might not have as bad of an impact as we're thinking, and this form will lay it out. Again, the caveat to this is how the form currently stands. The SBA could change this later on, but if you follow their guidance strictly line by line on here, the calculation, you could potentially get a full amount forgiven despite having a reduction in the FTEs. And I'm going to walk you through this to make a little bit more sense of it. So line 1 on here, and I'll tell you how we got to that number, but for this example, assume your total payroll costs were $1 million and you had a P3 loan of $500,000. Now, it's totally possible you could have spent more than the P3 loan because remember, your P3 loan was based on 2.5 months, but you now had up to 24 weeks to spend this amount. So in this example, in the 24 weeks, this business spent $1 million on payroll. And let's assume they had no other costs. They spent $1 million on payroll, but they did have some FTE reductions. So line 6 shows $1 million total costs, and line 7 is showing an FTE reduction, so it's going to be a 0.75. So when you multiply those two lines, on line 8, it's saying your max eligible for forgiveness is $750, which is still higher than the P3 loan amount on here on line 9. So according to the way this form reads, you could still be eligible for the full forgiveness amount because line 11 says it's the smallest of lines 8, 9, and 10. You could potentially be eligible for the full forgiveness amount despite having an FTE reduction quotient on here. Now, again, this is how the SBA set up their form. We don't know if at a later date they might change this, or this honestly could be intentional on their part, and they're trying to do this to make it very borrower-friendly. Unfortunately, this is one of those areas where you don't have a lot of clarity from them, but for right now, this seems to be very borrower-friendly and very favorable. This could help a lot of businesses that are struggling to get those headcounts up. Okay, so moving on from page 1. Page 2, I don't think we need to get too into the details on this. Just know that this is the representations and certifications that you're going to need to sign off on. It's pretty similar to those representations that you made when you had to get the original P3 application put in place. You're going to have a copy of this when you go online to your bank's portal. You're going to have to agree to all these things. You're not going to be eligible for forgiveness. So check this out beforehand just so you're not surprised by anything. But just know you're going to have to sign off on these, basically just saying that you followed the rules that they laid out and you were a good guy all around. Okay, so I'm going to actually skip page 3 for a second, and I want to jump into page 4 because page 4 lays out a lot of the details that are actually going to roll up to page 3. So I think it makes sense to kind of get a better understanding of the details. And as I noted at the bottom on here, this form is actually not required to be submitted to the SBA and your lender. This is just one of those forms that you need to have in case they choose to audit you or they ask for some documentation. So as you can see on here, there's 2 tables at the top. That bottom, it's probably hard to read on here, but that bottom piece is just a walk through the example of Safe Harbor 2, which I talked to you before about. And on the next slide, we're going to get into the details of these. But before we flip to that, just notice that that top table has 1 extra column compared to the middle table, and I'll explain why. So if you want to go ahead to the next slide here, we can dive into table 1. So this is where you're going to name all the detail for your employees' actual dollar amounts that you paid them. So table 1 is for employees that made $100,000 and less. So you'll enter the employee's name, their identifier, how much they made, what was their FTE, and is there any salary or hourly wage reduction. So that last column on here is where we put that salary or hourly reduction that they could be subject to. And I circled on here, you can see this is where that FTE reduction exception that we were talking about before gets in place. So if you were to list all your employees here, and then maybe you have like 3 reduction exceptions, you actually get to add that in here to the rest of your FTEs, which is going to bump up your FTE count overall. I know it sounds a little confusing. Once you sit down to do it or you work with us, we can definitely explain it to make more sense. Just know that this table is where you're getting the underlying supporting detail for how much you paid to all your employees. Now, table 1 lists all employees with $100,000 and less. In table 2 right here, you'll notice that last column is now gone. Table 2 is the same as Table 1, except this is for all employees that made $100,000 and above, or over 100,000, sorry. And there's no penalty if you reduce their wages. So you can see off to the right, there's nothing there, no penalty. So for this, you're just going to put their name in here, their identifier, how much they're paid, and what's their average FTE. Now for both these boxes, you're not going to put any of the owner information. There's a separate spot where you're going to put them in, and I'll show you that when we get to page 3. The last section though on page 4 is just that safe harbor that I was talking about earlier regarding the safe harbor for FTEs. And I mentioned before that they're very specific about the dates that you have to have this drop in FTE count. So as you can see on this, just looking at steps 1, 2, and 3, first they want to know what was your FTE at step 1 between February 15th and February 26th. And if that didn't go down from step 2, then you're not eligible for this safe harbor, which is unfortunate because a lot of people might have tried to tough it out through April 26th and dropped it in May. But according to the way the law reads right now, you're not eligible. Okay, next slide, please. Okay, so page 3 is really a summary of what we pulled from page 4. So we can actually go to the next slide even and drill into the detail a little bit. So on here, you're just pulling information from that 4th page. So you're entering, when we looked at the tables, they had different boxes. So you're dropping in the cash compensation, the FTE amount, and if you had any salary or wage reductions. If you didn't, you just check off that box and you put a 0 on line 3. Okay, we go next slide, please. Okay, so then on here in that very top part, you're just pulling again stuff from table 2. You're dropping the totals in there. It's pretty easy to follow on here. That's lines 4 and 5. Lines 6, 7, and 8, this is where you put in any amounts for your health insurance, employee benefit plans, or state and local taxes that you can drop in here. And be careful when you're doing this because some owner amounts are eligible for lines 6, 7, and 8, but some are not. So make sure you pay attention to that grid that Len had showed earlier, and you're including the appropriate amounts. I mentioned that the owners don't go in tables 1 and 2 from that other schedule. You'll see on here line 9, that's actually where you're going to list your compensation to the owners. You can drop it in there. Okay, so you take all those numbers, you add all of them up, and that's where you're going to get your payroll costs down here on line 10. And in my example that I was talking about before, that would be that $1 million that I was talking about. Okay, and then the last couple boxes on that page, this is really just where they get the details of those FTE potential reductions. On here, they have the safe harbors that I mentioned. You can check off the boxes if you have any of those safe harbors. If you don't, then you have to do a calculation to say, okay, what's our FTE during our covered period compared to our reference period, and then what percentage do you get? So on line 13, in my example that I was showing before, that would be that 0.75 that I was talking about on there. Okay, and page 5, this is just the optional page. You know, they're just trying to gather some demographic information. You can fill this out or you can pass on it, whatever you want. Okay, all right, so just to kind of recap that, when you submit the application, you have to send them a copy of page 1, 2, and 3, you know, your forgiveness calculation form, Schedule A. The guidance is kind of vague about what specific payroll documentation you need to submit and the FTEs, but the application says you need to submit that to your lender. I think each lender might vary a little bit, but I'd expect that they're going to require like 941s or payroll registers listing the employee detail, you know, the salary per employee, their hours, that kind of stuff. And then you also need to supply any supporting non-payroll documentation. Now, if you're submitting rent invoices, utility invoices, that kind of stuff. But given the 24-week period now, that might not even be as relevant. You might opt to just use payroll expenses because that might be more than enough to get full forgiveness, you know. So you can determine each situation. You might be able to save yourself the hassle from gathering every utility bill. You can just submit your payroll reports. They also specified a couple documents that you don't need to submit, but you need to hold on to. That's the P3 Schedule A worksheet. That's that page 4 that I talked about. And just have your documentation for your safe harbor calculations or employees that refuse to come back or anything else regarding the initial application for your P3 loan. And you have to keep this for 6 years from the date that your loan is actually forgiven, you know, because you could be subject to audit for that time period. So just put it in a safe spot, hold on to it so that you don't have to worry about it later. Okay. So I know that's a little bit confusing. That was a very high level view of that. And some of the calculations can get a little bit intense. So I'm going to kind of hand it over to Carolus right now, who can walk you through our solution that we had to help you out with that.
Thanks, Dan. So as you guys may have noticed, when you really start delving into the details, there's quite a bit to unpack. So what I want to do is just bring it back to, you know, a higher level view, and just bring back the focus on some of the more practical considerations that we should be looking at as you're going through your application process. So really the biggest ones in my opinion are, the 8-week versus the 24-week question. This question I think really depends on, anticipated changes in staffing levels. If you anticipate a drop in staffing levels during the course of the 24-week period, the 8-week period might make sense. But if your payroll costs are going up pretty significantly during the 24-week period, even if you have a drop in FTEs, you might still be okay. So the important bit here is, I think what I want to drive home is the fact that you need to be able to take a look at all scenarios, and these are just the kind of levers that we can pull on to see what the different scenarios look like. So one of the other levers is the covered period versus the alternative covered period. Again, I don't anticipate this applying to a whole lot of borrowers, but for some it might certainly make a difference. The full-time equivalency calculation, the standard methodology, and the simplified method, as Dan mentioned, this is an excellent planning opportunity for borrowers who have a lot of employees on the books, who work for less than 20 hours a week. Rounding up to 0.5 might be very beneficial. So something to consider, play around, and check the math both ways with the standard and the simplified method. And then finally, the application of the two safe harbors for the FTE reduction and the wage salary reduction. Those are important tools that can be used to kind of help get the best possible outcome. So if we can go to the next slide. The best way to maximize forgiveness is to calculate it, and to calculate it with all the alternative levers that we've kind of discussed. So we've developed a tool on our end to help kind of go through the process. There's a couple challenges when you set off to compute the forgiveness application and to complete it. And in our view, the main challenges are data collection, the calculations, the completion of the form, and finally documentation. So data collection is kind of a tough one because we're dealing with a lot of employee data. We're dealing, with period going back to January 1st, 2019 through today. And we need to be able to compute FTE counts per employee for that duration of the period. And then we need to be able to slice up periods that the SBA regulations call for. The covered period, our reference period. The reference period, again, can be different. It can be February 15, 2019 to June 30th, 2019, or you can opt for the 2020 reference period that goes till February 29th. So again, it's very important to be able to compare the outcomes of the two different periods and see which outcome yields the best result for you. The other item that's kind of important here is, as Len mentioned, owners and employees are almost two different classes of employee in the eyes of PPP forgiveness. Certain costs don't apply towards forgiveness when they're for owners and employees. So just important to have some sort of tool in your model that will be able to kind of take account of the different classes of employee. So whatever. And then again, the safe harbors are something to consider and incorporate into your model. So the one aspect is time and the FTEs. The other aspect is compensation. Again, your model should be able to kind of take different compensation levels for the different periods and compare them, and to the extent that you qualify for an exemption, to apply the exemption correctly in your calculations. So that's something to include there as well. So a lot of data can be received from the payroll vendors. We've seen that the payroll vendors don't always generate reports that are 100% accurate, so it's important to independently verify the calculations on your own. But some of the items that qualify for forgiveness don't always come from payroll vendors. A lot of times, some of the state filings might be done outside of the payroll vendor. So you need to be able to, take a look at retirement contributions and state unemployment insurance that might be occurring outside of the payroll vendor system, and you need to be able to capture that in your model. Again, kind of talking through the same kind of concept of, payroll vendors don't have all the information. The same is true for things like utilities and rent expense. You need to be able to incorporate all different types of expenses in your model and kind of roll that up into a singular calculation that aggregates everything for purposes of generating the form in the way that the SBA wants it presented. Next page, please. So again, just kind of illustrating, a lot of the schedules on the form require you to perform a lot of calculations on a per employee basis. So this is kind of just an example of how we've gone about, taking the information from some of the previous slides and populating it in the way that the SBA wants it presented on their form and their schedules. So again, this is kind of the same story here. Just want to give you guys an example of the tables, aggregating all of the employees and their compensation FTEs from the previous slides. More of the same here. So again, I think the key here is, once you have all the information, you need to be able to put all the information together and transition it into the way that the SBA wants it for proper transmittal to the SBA on their forms. So I'm going to transition this over to Bill, who might have some closing thoughts here.
So one just clarification with respect to that software, Carolus. The software designed so that we go back and forth between, just as an example, the simplified method and the hourly calculation, and it allows us to maximize the forgiveness when the data is loaded in there correctly.
Yeah. So I guess just to kind of clarify that, yeah. So the model that we have allows us to kind of play around with all the levers that the SBA has provided us. The different methodologies, the inclusion of all the different safe harbors, and kind of figure out what is the best outcome for the borrower, depending on their facts and circumstances. That also includes the 8-week versus the 24-week period. A lot of borrowers are having a hard time deciding on, if they do have a reduction following the 8-week period, is it better just to not have as many payroll expenses and with higher FTE quotients in the 8-week period, or is it better to have lower FTE quotients and higher payroll costs? So those are kind of some of the levers that we can take a look at and optimize.
Thanks, Carlos. So to just, we're getting kind of late in the hour here. To wrap up a few key open items, as was mentioned earlier, this FTE reduction looks like it may not materially impact forgiveness if you've elected for the longer period, the 24-week period, because what the form is allowing you to do, the way the form is constructed, is to consider costs in excess of the amount of your loan, and then applying the FTE reduction against that larger number. And even if there is a haircut, if you will, on that larger number, it still could be in excess of the loan amount. It seemed counterintuitive when we first went through this on the form. Clearly, this is what the SBA has said, and we're hopeful that this is intentional to be business friendly. The next point is yet to be played out. As we mentioned earlier, the forgiveness of the loans are not taxable, and that's in the statute. After this law was passed, the IRS came out and issued a notice that said that the deductibility of expenses that are forgiven are not going to be allowed to be deductible for income tax purposes. Congress kind of balked at that indication from the IRS. It wasn't their intended outcome when they wrote the statute, or they wouldn't have written that the loans weren't taxable. Hopefully we'll get some clarity on this issue, and that could even come after the election, so that it will be understood well when we're getting down to filing 2020 tax returns. As I mentioned earlier in the opening, it's possible, depending upon what comes out of Washington, that there could be additional rounds of funding or further extensions of time. This is all the subject of the political process, which right now looks like it's not moving very well. The additional rounds of funding could be directed towards businesses that have really had a serious impact on their revenue. There could be some revenue test that applies it. Another open point is, what does it mean to have an audit, and how will that process play out? How will the timing of it play out? What details will it entail, and what will they be looking to cover? And then, of course, some businesses have had a concern about the provision in the law that says, was the loan necessary to support the ongoing activities of the business? And how will that be tested? Will it be as of the date the loan was applied for? Is there going to be some hindsight in the situation? So our thought process here is that you want to make sure that you're thoughtful when you apply for forgiveness, and you want to make sure that you have considered all the other options that may be available to you, especially if you are coming up with a calculation that doesn't give you full forgiveness. Always doing things that make business sense. Make sure you have the appropriate documentation prior to applying. And then we can work with you if you choose to utilize us to take advantage of all the opportunities that are out there, and we can do the what-if scenarios very easily with the tool that Carolus identified. And that more or less wraps up the program. We didn't have time to get to questions, and we're right at the 1 hour mark. I apologize for that. We will take a look at the questions and get back to them in the next few days as we can. And I encourage you folks to take a look at the handouts and download them off the site. And in addition, there'll be a recording of this presentation that'll be available on the site probably within a couple of hours of when we conclude. So having said that, have a nice day and good luck with your forgiveness application.